You have invested your money in a money market fund, or what is commonly known as MMF. Perhaps you have been depositing 10,000 per month, hoping to increase your savings that would earn enough to accumulate your riches and grow your wealth. Of course, it's good to see your money growing instead of leaving it in a regular bank account. But what if I told you that your money is not growing that much? The numbers in your account could be going up, but the wealth you imagined is not quite materializing. That even after investing for years, your financial situation will not be dramatically different. The truth is that many Kenyans have misunderstood the purpose of a money market fund. Social media is full of people recommending MMFs as the perfect investment, and while they are one of the best financial tools you can own, they were never designed to make you rich. In this video, I'll explain why your money isn't growing as fast as you expected, the biggest misconception about MMFs, and how you should actually use them if your goal is to build real long-term wealth. By the end of the video, we'll know exactly where an MMF fits in your financial journey, and just as importantly, why it doesn't. And before you get started, I kindly ask you to like this video and subscribe to this channel. Please help me get my first 1,000 subscribers within the next few weeks. So let's get into it. Before we go any further, let's start with a quick introduction of money market funds for the sake of those who are new to this financial tool, and also to ensure that we are talking about the same thing. So, what is a money market fund? A money market fund is an investment that pulls money from many investors and places it in relatively low risk short-term investment like treasury bills, government securities, bank deposits, and high quality corporate debt. So your money is not just sitting idle in the account, but it is invested and you receive a share of the returns the fund managers get. And MMFs have become very popular in Kenya in the past few years due to several reasons. The first reason is the higher returns offered by these funds when compared to traditional banking savings accounts. In the years 2023 and 2024, these funds offered yields as high as 14% compared to just 5-6% in the traditional bank savings account. The second reason is the low entry barrier. Right now, you can start with the 100 shilling and you have your account. Also, MMFs have high liquidity. Most providers allow you to withdraw your money quickly. You can withdraw your money and get it in your phone within a minute. And all this sounds great. So why your money feels stuck when you choose to invest in a money market fund? Let's use an example to demonstrate. Suppose you have 500,000 invested in an MMF, earning around 6, 7 or even 8% per year before taxes and fees. That might sound impressive, but now consider reality. There is inflation. Prices of food increase, rent increases, fuel prices change, school fees is going up, medical expenses become more expensive, and Kenya's inflation has been averaging at around 5.3%, and in July this year, the annual inflation rate was about 6.5%, and that's huge. Now, if we calculate the real returns you get from MMFs, and to calculate the real returns, we take the rate paid by the fund and subtract the inflation rate. So if you invest in a fund that offer you 7% in returns and the inflation rate is 5.5%, your real returns is only 1.5%. And in fact, the real returns for many funds ranges between 1, 2, and 3%. Of course, depending on the inflation rate at that specific time. This means that even if your investment grows, the value of your money may not grow by nearly as much as you expect over long periods. This is why many people don't feel richer even after many years of investing in money market funds. The goal of investing money or investing your money in money market fund is increasing or maintaining the value of your money or what your money can actually buy over time. Now, let's go to the biggest misconception about MMFs. When investing in MMFs, many people confuse protecting wealth with creating wealth. These are two completely different goals. Imagine you own a motorcycle. A garage protects your motorcycle, but the garage does not make the motorcycle more valuable. That's exactly what an MMF does. It protects your money reasonably well against inflation. It gives you stability. It reduces risk. But protection is not the same as growth. MMFs does not grow your wealth. If your goal is simply to keep your money safe until you need it, an MMF is an excellent choice. But if your goal is to become financially independent, relying on an MMF is usually not enough. Money market funds are excellent options for putting your emergency fund or money that you'll need within the next few months or couple of years, saving for school fees, a car deposit, or a planned purchase. But if your goal is to build wealth, you can't stop at MMFs. What I will recommend is to use MMFs to accumulate money for your next investment. Like if you want to buy a rental property, you might first save the deposit in an MMF because you need that money to stay relatively stable and accessible. If someone plans to start a business in 6 months, an MMF can be a good temporary home for the capital. In these cases, the MMF is helping them manage the money and also maintain the value of that money. It is not the main engine creating wealth. Their wealth comes from productive assets that have the potential to grow over many years. So if MMFs are not enough on their own, what builds wealth? There are different ways. First, increasing your income. You can only invest what you earn and save. Developing valuable skills, starting a business, or advancing your career can have a much bigger impact on your finances than trying to squeeze a little extra return from your savings. Aim to have multiple sources of income. Second, owning productive assets. Over long periods, diversified investments in businesses, shares, or income generating property offer greater growth potential than cash like investments. Although they also come with higher risk and greater price fluctuation. Third, consistency. Be consistent when it comes to investing. Many people chase the highest return every few months. Wealthy investors often focus more on investing regularly and staying invested over the long term. Time can be one of the most powerful tools in investing. If there is one lesson I hope you remember today, it's this. An MMF is a tool, not a complete wealth building strategy. It's one of the best places to protect your money against inflation, maintain liquidity, and earn a reasonable return with relatively low risk. But if your dream is financial freedom, if your dream is to build wealth, you likely need to combine that stability with increasing your income and investing in productive assets over the long term. The biggest mistake is not investing in an MMF. The biggest mistake is believing that an MMF alone will make you wealthy. I would love to hear from you. Do you currently invest in an MMF? What has been or what has your experience been? Share your thoughts in the comments section below. And If you found this video helpful, give it a thumbs up and subscribe to the channel and follow us, because every week we talk about personal finance, investing, and building wealth right here in Kenya. Thanks for watching, and I will see you in the next video.